Welcome. As you can see, we're trying an experiment tonight. This is the first live satellite broadcast between Edinburgh and London for CPD. So in terms of the agenda, we're doing simultaneous introductions between Edinburgh and London, myself and Paul. And then Andrew Chamberlain is then going to give us an overview of his experience in front of the Treasury Select Committee last week. And those who've had a look at the TV footage on the website will be able to see it was the full. He was subject to the full performance, so he'll update us on that. Then we've got presentations from two working parties, from Dick Ray in London, who's going to give an overview from the retrospective of Solvency II working party, and then Andy Rogan's going to do a presentation from here to Edinburgh and to London on the transitional measures of technical provisions working party. I think when we do the presentations, we may see slides but no speaker, but there should hopefully be a voice doing the speaking. Otherwise, you're going to have to listen to me reading out Dick's script, which could be slightly iffy. But we'll see where we get to on that. So, moving on, as we said, the meeting's been streamed between here and London. So, when we get to the Q&A session, which will be the last hour, can we make sure we go to the microphones and speak into the microphones and state your name clearly? Speaking to the microphones will also guarantee that the people in London will be able to hear the question. At least I hope it will help with that respect. If we could also ensure mobile phones are switched off and silent during all the sessions, that would be helpful. And if the fire alarm sounds, please leave by the nearest fire exit, and staff will be on hand to help us out. And we should now be going back to Paul in London, who will introduce Andrew for the first section of the meeting. We're listening to you, Paul.
Yep, are you ready? Ready. Okay, well in that case I'll hand over to Andrew. So Andrew Chamberlain, so the benefit of people in Edinburgh, Andrew Chamberlain, Chair of the Life Board.
Well, thank you, Paul and James, for giving me the opportunity to speak. The occasion last Tuesday morning when I was giving evidence with Philip Smart of KPMG and Jane Portas of PwC to the Treasury Select Committee on behalf of the Institute and faculty is a relatively rare event. I do recall there have been appearances on behalf of the profession at a Select Committee, but it was more defending the profession's role in situations that weren't very happy. This is one of the few times where we've been able to give evidence to the Treasury Select Committee with the role of expert and to try and give them a better insight into a matter. And I think it's important for those who are not really closely aware to understand the role of the Treasury Select Committee. There are 19 select committees of the House of Commons that relate to various government departments and functions. And amongst those select committees, the Treasury is either the most or the second most influential. The Public Accounts Committee is also a very influential committee. And as a consequence, it does attract some quite influential and expert MPs to its number. It's a mixture of devout Brexiteers, like, for example, Jacob Rees-Mogg, and a significant number of those who had been Remainers. Interestingly, last Tuesday, it was difficult to tell who was who, and clearly the committee was operating on the basis, to quote the Prime Minister, that Brexit means Brexit. And that, I think, made things run very smoothly. There were a lot of interesting questions that the committee posed, from is Solvency II suitable for the UK at all? Would we be better off giving up Solvency II and doing something different? And what actually is the importance of equivalence to UK firms? And we tried to give some general picture, as factual as possible, on those issues. Perhaps the most surprising question, which I wasn't ready for, but tried to answer as best I could, was should the PRA have a full objective on competition and encouraging competition in the industry? So I had to think a little bit on my feet on this one, came out in the conclusion that actually it should. The reason being that I think the PRA sometimes has lost sight of the importance of what it does to the general public. And I think the competition objective that the FCA has and the FSA had was quite instrumental in keeping that point of view in place. I'll be interested to hear in the discussion those who might disagree with the line I took. The panel that was there was not unanimous on this. Jane Portis thought it shouldn't, I thought it should, and Philip Smart sort of went halfway in between. Maybe it should, maybe it shouldn't. I was very impressed, particularly one of the members, Jacob Rees-Mogg. He clearly had a clear understanding of his brief on the Solvency II, both in relation to the risk margin and to matching adjustment in particular, and the constraints that they produce. And we had some quite interesting discussions. And it was quite interesting that Jacob Rees-Mogg actually drew the analogy between the role of the risk margin and the fact that a pension scheme can be solvent on the regulator's basis, but if it actually wants to buy out, it needs more money. And the risk margin actually, in many ways, performs the same function. So I thought that was quite a powerful analogy for him to draw. I think very clear messages went across from the team, that's myself and the two, I think they're both accountants, that there was a need to make some changes to Solvency II, and that very much the constraints on investments for the matching adjustment were one of the biggest issues. I made the point, which was based on the work that had been done by the professions team, and I must congratulate the team who backed me up on this session. They were extremely helpful, they prepared me very well, and the work that in particular, I'm only going to pick out one name, but Stephen Graham has done a tremendous amount of work since the Treasury Committee announced its inquiry, both in doing most of the work in drawing up our written submission and in providing me with lots of material so that I had it at my fingertips if I needed it, and Bracey's as well, in front of the committee. But I think the point I made based on those researches we'd done within the professions bodies was that actually the life community seemed to be much more concerned about the constraints of Solvency II and less about the equivalence issues, whereas the General Insurance Committee was probably the other way round. The General Insurance Board was worried about equivalence, but not quite so worried about reforming Solvency II. Like all generalizations, as I said to the Treasury Committee, Select Committee, that's a generalization, and that there will be exceptions to that. The other point that I made was the way that Solvency II works on the basis, it talks about working on the basis of going concern. But actually what it challenges you to do is to hold enough capital not only to survive extreme events, but through the risk margin to have sufficient margins thereafter to encourage recapitalization to withstand another such event. And and the profession's written submission and my remarks at the committee invited them to consider whether that was actually too much and the cost to consumers through the cost of capital that was passed on to them was too great for a level of security that was very high indeed. Effectively, I described it as the insurance premium on insurance premiums. I don't think I want to go into very much more detail about the way the Treasury Committee operated, but I think it was interesting that they were very concerned about the role that Solvency II might have on the economy at large. They were worried, as many people of course are, about the constraints on insurers' investments and the monies not being available to help the wider economy and jobs in the wider economy. That was clearly something that was underlying their thinking. They were worried about whether, in fact, Solvency II, by its very nature, encouraged insurers all to do the same thing, whether that's because of the standard formula, which they were definitely not very keen on, or whether it was because internal models were going to be very similar, and that might increase the risk in the system rather than reduce it. And again, I thought that was quite a powerful argument for politicians to be putting forward. And perhaps as a sort of final line, they were wondering what would happen to Solvency II in the future, with Britain no longer having a voice at the table. My view was that it probably meant that the matching adjustment wouldn't be high on anyone's agenda. The Spanish use it. They have some sort of product that meets the requirements. I don't know what that product is, but I know it's not an annuity like it in the UK. But very few other people actually use the matching adjustment in Europe. So I didn't think that was going to be high on anyone's agenda post-Brexit. But what else they will do with Solvency II, I think it would be interesting to hear whether anyone has any views, apart from those things, of course, they've already said they're looking at. Of course, when they look at something and what they do about it can often diverge quite widely before you get to the final outcome. And the other thing that seemed to be quite interesting was currency risk. Clearly someone had made a big point to the Treasury Select Committee about the fact that you hold capital in sterling or euros, depending on where you are, for risks that may be in dollars. And I think that was interesting that they were so concerned about that one. It's obviously a very real problem, but it didn't seem one that I was expecting politicians to make a big play on, but it did seem to be particularly interesting to the SNP member. Shall I stop there, or?
If you feel that's the right place to stop.
I think so.
I wasn't going to curtail you. Okay, well in that case, I'll hand over to Dick to talk through some slides on the Solvency retrospective.
Right, well good evening everyone here at Staple Inn and to all our folk in Edinburgh. So for the last year I've been chairing a working party that has been conducting a retrospective on Solvency II with a focus on long-term guarantees. And I'm delighted to be here actually to share our thoughts and add those to the debate. Our working party has been standing back and assessing the outcome of Solvency II against its original objectives. And for those of you who forget what they may have been, it's to improve consumer protection, it's effective risk management, harmonisation and financial stability. Our goals have been to look at the success of Solvency II, present our findings for discussion, and our goal is to produce a sessional paper later this year, and to inform the debate for what we thought would be the EIOPA review. Brexit, of course, has added a new dimension to the debate and causing the Treasury Select Committee to look at European insurance regulation and to consult on its suitability for the UK. Our working party, along with the practice boards and other relevant working parties, had an input into the profession's response to the Treasury Select Committee. And I just want to echo what Andrew said, that Stephen Graham did a superb job in bringing together in a form that the Council could agree a huge number of comments on that consultation. As you know, this was followed by the oral evidence, and Andrew's just given us his feedback from last Tuesday's session. And I have to say that congratulations to Andrew for doing an extremely good job there. And it's good now that we have an opportunity this evening to share our individual views and comments and continue to inform the debate. The consultation, as Andrew said, looks at competition, changes that we in the UK would like to see, and indeed whether to leave Solvency II. It mentions the risk margin, asks about the costs and complexities of implementation and the transitional arrangements. In particular, it picks up the benefits of passporting and whether Solvency II is a price worth paying. It is clear that there are fixes to Solvency II that need to be made, but the legislation is more than the calculation of technical provisions and capital requirements. It's about embedding risk management and good governance within the boards of insurance companies and clearly defining where their responsibility lie. Indeed, Pillar 2 aspects, such as ORSA, are similar to the ICAS regime that we know and are a huge improvement over Solvency I. Much of Solvency II, in fact, has the DNA of the UK throughout it. By contrast, though, Pillar 3, in our view, needs revisiting. It is unduly onerous and where the benefits of some of the detailed reporting are questionable. Actually, I'm going to stand up so you guys can see me a bit better. As a consequence, our working party feels that the UK should retain Solvency II as a framework, but take advantage of our ability to adapt it to meet the UK's needs. Without the need to reach agreement with 27 other member states, the UK has greater scope to accept to adapt Solvency II to address its shortcomings. It's also worth bearing in mind that if the UK chooses to retain Solvency II, then with no voice, Solvency II could evolve in a way that does not suit us. As an example, as Andrew said, there's no great attachment to the matching adjustment on mainland Europe, and the risk is that it could be removed. We should aim to avoid being locked into Solvency II, where we have no say and where changes could potentially go against the UK. Okay, let's have a look at a number of issues and opportunities. Andrew, can you? Passporting and equivalence through mutual recognition of the UK's and EU's regulatory system is a highly desirable goal. This is especially true for the international nature of business carried out by Lloyd's of London and in the London market. For multinational life companies, this is perhaps less important, given the current norm is to operate through legal entities within the EU. If we change too much, passporting and equivalence could be at risk, but these agreements are made between governments. The USA enjoys equivalence with the with the EU, even though there are significant differences between these two regimes. Even within the Solvency II regime, there is not full harmonisation. German companies with long-term with-profit liabilities take advantage of an extrapolation to the UFR from the 20-year point. They do not compare to UK annuity writers that take advantage of the matching adjustment. One of the Treasury Select Committee strands was questioning the extent to which Solvency II is too prudent, principally for business with long-term guarantees. The Treasury Select Committee made a good point around the fact that because the PRA has no responsibility in respect to competition, allocating more money to back insurance liabilities and their capital requirements is an easy way for the regulator to improve policyholder protection. In the meantime, new policyholders have to pay more. Andrew also made the point in his oral evidence that the level of prudency is a political decision. We would agree. What we can do is highlight the extent of the prudency and the impact this may have on competitiveness. The point was made in the oral evidence that Solvency II is the most sophisticated regulatory regime in the world. Its foundation for the calculation of technical provisions and capital requirements is market consistency. Its design moved us to a framework that has demanded a true best estimate of the liabilities and a 99.5% one-year VAR as a capital requirement. Omnibus 2 recognised that for annuity risk or annuity business, it was default risk rather than spread risk that counts, and this was accommodated through a higher discount rate and lower capital requirements. The liability is now linked to the assets that the insurer holds. This break from market consistency now makes it possible, in certain instances, to be rewarded by taking on credit risk. Next slide. At last year's Life Conference in Edinburgh, our working party had a workshop at which we asked whether aspects of Solvency II that were not market consistent should be removed. From this slide, you'll see that there are certainly differences in viewpoint as to how much we want Solvency II to be market consistent. Within our own working party, we do not have agreement. Looking at those responses, I was surprised that there was not a greater support for it. And it will be interesting to see if there is a response to that this evening. It raises the question, is market consistency a useful tool to provide a general approach, a foundation, or is it an end in itself? Or even whether it works at all for long-term guaranteed business? The Treasury Select Committee session pointed out the flaws of a dogmatic market-consistent approach, but it's through market consistency that effective risk management is rewarded. Indeed, there is a concern around the pro-cyclical nature of market-consistent approaches, and questions are being asked about the going concern approach of Solvency II compared to the run-off approach of Solvency I. Pro-cyclicality and financial stability are areas where we can inform the debate. Market consistency will always be pro-cyclical. If markets fall, it makes sense to hold capital against further falls. For insurers without enough spare capital, this can result in their selling risky assets, creating pro-cyclicality with potentially disastrous outcomes. A good point that Andrew made in giving his defence is that markets can overreact. They are not deep and liquid. Insurers writing long-term business don't have immediate cash flows to pay. In our workshop at the Life Conference, if we can look at the next slide, there was agreement that a capital regime that provides time for insurers to formulate a measured response could be desirable. The symmetrical adjustment for equities achieves this, but its effectiveness is restricted by the 10% limit on the size of the reduction. It does, however, give time for markets to find their new level, if they've overreacted, that is, or for insurers to formulate their best response if they have not. Variations to this, and applying it to other market risks such as spread risk, could be one solution amongst a range of other solutions that could be usefully assessed. Next slide. Yeah. On the risk margin, annuity is probably the most important long-term guaranteed business written in the UK. And amongst a number of other issues, the risk margin has been thrown into the spotlight by the current ultra-low interest rate environment. The concern around the risk margin in the UK is about its magnitude and volatility. This has given rise to a number of issues and questions being raised. Next slide. For this, there are a range of solutions being suggested. One proposal is to reduce the size of the risk margin by assuming longevity risk can be treated as though it's a hedgeable risk. Certainly, rules ought to be amended so that hedging of any interest rate risk volatility is rewarded. There are arguments to reduce the 6% assumed cost of capital, particularly when rates are low. And of course, there is the option to completely revisit the design of the risk margin in totality. As with many other aspects of Solvency II, there are numerous solutions, each of which warrant individual assessment before a single recommendation can be made. This is a role for more specialist working parties than our own. Slide. Finally, there are compliance constraints and burdens. The need here is to look forward. Whilst there were lessons to be learned from the way that Solvency II was introduced and the costs associated with it, the fact is that the investment has been made, and we now have a regulatory regime that is appropriate for a modern insurance industry, adopting current technological advances. It also contains many features that the UK would want to retain. There are a number of burdensome and costly areas remaining that would benefit from a review. Slide, Andrew. Thank you. These are areas that can affect profitability, discourage new business, and reduce the competitiveness of the industry. For example, in respect of annuity business, investment returns opportunities are reduced through ineligibility of assets such as equity release mortgages and restrictions on trading bonds. The consequent need to repackage or package assets to meet eligibility rules increases costs and absorbs resources. Tight cash flow matching requirements and other eligibility rules are also increasing costs. Elsewhere, there are approval processes such as IMAP and the approval for the matching adjustment that could be made more efficient. Currently, they are lengthy, costly, and burdensome. Within our working party, we question whether internal models are too complex and too detailed for the purposes that they serve. Furthermore, the current process to introduce changes to the internal model potentially inhibit innovation. Last but not least, in terms of burdens, there are the detailed reporting aspects of Pillar 3, where the benefits of certain parts do not appear to justify the costs. The whole process of looking through to the assets within funds, layered within funds, requires huge amounts of processing with its associated costs. And it's not clear how the information benefits regulators or analysts. Brexit may permit streamlining and simplifying of systems and processes that could make our industry more flexible, more competitive. So in conclusion, a combination of a more financially rational reserving and capital basis, along with increased conservatism, has improved protection for consumers, but at the cost of higher premiums for new business, for new policyholders. Solvency II has scored highly in the way that it rewards financially rational behaviour, although in the UK, the matching adjustment has actually diluted this. Through the setting of governance standards and aspects such as ORSA, Solvency II has raised the bar considerably. We should certainly keep the Solvency II framework, but take the opportunity of Brexit to focus on making it better for UK needs. But we should not lose sight of the benefits of negotiating equivalence and passporting with the rest of the EU member states, especially for the non-life sector. The profession has a role to play in adding its voice as to how the regime can be improved. There are, however, many views and even divergent views within the profession. The Institute and Faculty of Actuaries gave its written response. Andrew gave his oral evidence to the Treasury Select Committee. This meeting is our chance to add our comments to make sure that the profession captures the breadth and diversity of opinion. And I certainly look forward to an interesting debate. Thank you.
Thank you. Can we switch over anybody?
Thank you, Dick, for your presentation. I'm now going to hand over to Andy Rogan, who's Senior Manager at Lloyds Banking Group and is a member of the Transitional Measures Technical Provisions Working Party. He's going to talk you through the next presentation. Thanks.
Thank you, James, and good evening, everybody, wherever you may be. I take it everybody can hear me in London? Wave if you can. Hooray, excellent, thank you very much. I have to say that I'm not a particularly experienced speaker, so being asked to stand up in front of so many distinguished people in Edinburgh kind of raised the anxiety level somewhat. And when Mary Russell at the IFoA HQ told me that I would then be projected down to London, those anxiety levels kind of grew to an almost terrifying degree. So this is a new experience for me, and one that's almost as terrifying as wading my way through Solvency II transitional measure and technical provisions, regulations and issues, almost. So I'll move on. So what am I going to talk to you today about? Just a very brief introduction to the transitionals, and I think I will call it transitionals because transitional measure on technical provisions is a bit of a mouthful. I'll maybe just cover a few hot topics, give an overview of the working party, another overview of the recalculation itself, and then kind of wrap up with a summary. And then I think, with technology permitting, we will go to a Q&A where we'll alternate questions across sites. Fingers crossed. So what is the transitional? It essentially gives firms a soft landing into the Solvency II regime. Relates to pre-2016 business, as you would well expect. And for those who are not familiar with the detail of the transitional, it's essentially the difference between Solvency II and ICA technical provisions allowing for a restriction. That restriction essentially looks at the Solvency II financial resources requirement, as the PRA call it, which is your current liabilities plus your technical provisions plus your capital requirements. You then compare that to your biting Solvency I equivalent of Pillar 1 and Pillar 2, and that's your restriction if a restriction applies. And if I kind of just think about where does the transitional arise, and I'm just kind of thinking about differences between Solvency II and ICA here. Well, we've got things that are new or different for Solvency II, like risk margin is a big one, also contract boundaries, differences between matching adjustment and, or no matching adjustment and liquidity premiums. And then there's things kind of from the old regime, some ICA regime like ICG and closure expenses. And if I could just draw your attention to the table on the right, and if you can see the UK at the very bottom of this table, this table's been taken from the long-term guarantee paper that issued by EIOPA in December. I think it's based on 1 January 2016, but the kind of circled chart at the bottom shows that the transitional does actually make a considerable difference to UK firms' average balance sheet. I would probably guess that's a difference between paying a dividend and not. And being January, we're kind of getting into reporting season, and it's likely that the kind of range of output and disclosures from firms across the UK will increase, and I'm sure that there will be a wide breadth of disclosures, and it'll certainly make for very interesting reading and peer-to-peer comparison. And it'll also be very interesting to see just how analysts react to the size of the transitional, specifically, especially for those companies with large annuity books and large risk margins. A few other things that have happened kind of over Christmas. EIOPA have released guidance on disclosures of information around how firms will treat the runoff of the transitional. Transitional's got a 16-year lifetime. Regulations say that you kind of run it off after on the 1st of January each year. That's not quite the same as the your annual disclosures that will be at the 31st of December. So EIOPA have come out and said that you can it's perfectly okay to reduce your transitional on the 31st December, and also quarterly if you so wish. But if you do go down the route of running off at 1 January 2016, kind of reminding firms that they must show a true and fair view of their balance sheet and make sure that they show the effect of the runoff in their SFCR. The PRA released a kind of early Christmas present, a new consultation paper on the recalculation of transitionals. It's an update to Supervisory Statement 616, which was released in May last year, and that kind of covered the main part of the main recalculation, or what they expect from firms in terms of recalculation. The working party is certainly looking at the consultation paper and will be reporting into IFoA around around that, and we're thinking about whether to respond in that regard. First read is that there's a lot of helpful clarifying points. They do promote a proportional and a pragmatic approach to recalculation, which I think is very helpful. There's some kind of quirks and points to maybe clarify in the text, but overall helpful on first read. Also coming up, and that's slightly further down the line, transitionals, PRA expect them to be recalculated every 2 years. So I guess that's coming up at the end of 2017. And there's potentially more political and economic uncertainty on the way. Who knows? So more material change. And that's kind of reflective of the fact of, last year we saw a lot of big change in interest rates, big changes in risk margins, and the PRA came out just after Brexit to say that they were inviting firms to recalculate or apply to recalculate their transitionals, and many firms did recalculate their transitionals at the half year. I realised I just missed a bullet there. Bedding down of internal policies and methods for recalculation. As I say, firms have already gone through their potentially one recalculation already. That's probably been helpful, so close to the implementation of Solvency II, whereby firms have a strong reference point to their kind of year-end Solvency I balance sheets. How that moves forward in time is something to think about. And also just general governance arrangements and how methods will evolve through time is something to think about. And last but not least on this slide, phasing in plans. So regulations require firms to have a phasing in plan if their pre-transitional own funds cannot cover their solvency capital requirement. Based on the long-term guarantee report, no UK firms had a phasing in plan at the 1st of January, but that might have changed given the interest rate volatility experienced last year. Moving on to just a quick overview of the Transitionals Working Party. It is a short-term working party. We first met in July last year. We've got a key focus on just the general challenges of recalculation, the options available, where you can be pragmatic and proportionate, what good practice looks like, and also having a look at emerging guidance, such as the consultation paper that has just come out. The main outputs will be a paper. I think it's on version 27 and standing at about 85 pages at the moment, but hopefully that will come out in Q1 2017. A presentation was made at the Life Conference in November, and have to say that's the first time I presented at the Life Conference, but I felt there was really good engagement and interest in the subject, so good to see firms and members thinking about it. And lastly, as I've already mentioned, we'll be thinking about an input into an IFA response to the recent consultation paper that has been issued. So areas of consideration, the working party thinking about that will be reflected in the paper. Calculation practicalities, managing solvency in terms of how does the transitional interact with your ALM policy and your hedging. And also just thinking about good practice for communications and also looking a bit to the future, in particular around, as the transitional runs off in the future, it becomes a less material aspect of a firm's balance sheet. So that may well support a more proportional approach to recalculation. Members of the Working Party on the right, I would highlight that Anthony Plotnick is in the London audience. So Anthony, if you want to just give the London guys a quick wave. I'll presume you're waving as we speak. Anthony's particular expertise is answering all the difficult questions, so I'll leave them to him to pick those up when we go to the Q&A. So I'll just move quickly onto the TMTP recalculation. Again, this will come out in the Working Party paper, but there's just a kind of some sensible high-level questions to ask. Who's responsible for the recalculation? When do we recalculate? How do we recalculate? So there's a whole load of who's responsible and good governance stuff that we should really be doing. Thinking about all firms should really have a recalculation policy. I've seen a recent consultancy survey that suggested all firms didn't have that. And I think it's something that the PRA expect, that there's a particular point in the PRA around making sure that recalculations under material changes are symmetric. And I think it's important that firms capture that in their policy so they can demonstrate when they do apply for a change that they are being symmetric. There's also a bit about making sure that you make sure you have got good governance around when you decide to make an application. I think PRA expect board to approve or be content that you make the application. There's just general overseeing recalculation activity monitoring that needs to be an ongoing process. Not just about whether you hit the triggers for a recalculation, but also whether you require to put in place a phasing in plan. And lastly, Audit Committee will be heavily involved, certainly in approving the recalculated transitional once you've had approval from the PRA to recalculate, and they may well get involved in the approving the method based on the most recent consultation paper. So when do we recalculate? Transitional's got a 16-year runoff. It runs off linearly except for recalculation, and those recalculations can happen in the event of a material change in risk profile. So that can be something like a change in interest rates like we saw in the first half of the year, and invitations to recalculate were made by the PRA. Could be something like a more structural, like a Part 7, or a change in the matching adjustment approval or something along those lines. And then, of course, we've got the kind of the biennial recalculation that the PRA have requested, and that's kind of highlighted in the supervisory statement that was issued last year. Already mentioned defining recalculation triggers. Important that those are well documented and in your policy. That's something that certainly the PRA will look at when you make an application to recalculate. And then, of course, application process. There is a lag when you apply to recalculate, both from getting internal approval to submit an application to recalculate through to the PRA actually approving that application to recalculate, and all the way through to getting approval from the Audit Committee to reflect that recalculated transitional in your Solvency II disclosures. How to recalculate? Well, where do you start here? There's any number of options to think, issues and options to think about, and I'm not going to go into too much detail on the ones on the page. Certainly the Working Party paper will go into that a significant level of detail. But what I would say is on how to recalculate, the PRA do support a proportionate approach. How proportionate is proportionate, I don't know. I'm sure that will vary from firm to firm, depending on the materiality of the transitional. But there's a real opportunity here for firms to fit the recalculation approach to how their business is set up and run. Some firms may be able to split their model points or their data at the drop of their hat. Some firms may find it a bit more difficult. I'm talking about pre and post 2016 business here. There's a whole raft of things to think about in terms of apportioning the risk margin when you're sharing assumptions and correlations and non-hedgeable SCRs and things like that. So there's an awful lot to think about. The Working Party paper will hopefully go over all the things you need to think about, and also try and kind of give you some real life examples of how you might address some of those issues. So, in summary, transitional is there to facilitate a smooth transition from the previous Solvency I regime. I'll plug again, the Working Party paper is due to be released in Q1. Pressing issues at the moment are year-end 2016 disclosures and how firms will reflect those transitionals in their disclosures and what analyst reactions will be. There's 2017 biennial recalculations to follow. Bit of bedding down of methods and policies. Consultation paper to be responded by. I think that, as I say there, the response is due by the mid-March, so get your responses in. I think you've got a couple of months to do that. There's some key questions to be asked of your policy both now and in the future. Who is responsible, when to recalculate, how to disclose. Firm, obviously recalculations will be firm specific and should be proportional, including simplifications. And lastly, I would say that methods will, of course, evolve over time and should be kept under regular review. Again, if you've got any feedback for the working party, just let myself know or Anthony in London, or you can get in touch with Jamie Cook, the working party chair. And on that note, I will cross both my fingers here and hope that this live link or Q&A works. And do I pass over to James now?
Hi, thanks Andy. I'm hoping this will work, and I'm hoping London will reappear on screen. Well done, it did. Paul, hi. So myself and Paul discussed earlier around questions and how we would operate this. And we thought we would try alternating between Edinburgh and London. And in order to help have a feel for how many questions were outstanding in each venue, we'd try and operate a bidding system, and introduce an element of competition in this. So don't wait. So if you could all raise your hands when you have questions, just to have a feel for how many questions there are in Edinburgh, then I'll let Paul know that we've got plenty of questions waiting if London's flagging. At least that's what I'm hoping to be able to do. So we'll open up with the first question, or comment, or statement. This is going well.
Have anyone in Edinburgh?
No views in Edinburgh on Solvency II?
Yeah, well, London's ahead. They've got a few contributions here, so... can you just say your name before you speak and speak in the microphone? That would be good.
Dylan Brooks from the Phoenix Group. I'm also on the working party that Dick was presenting. It's a question for Andrew. What's your view on the difference or the consistency of the PRA's implementation of Solvency II in the UK compared with the rest of Europe? And do you have any concrete examples where the PRA have done something which is maybe more prudent than the rest of Europe, or the other way around?
Yes, very interesting question. It was alluded to during the Treasury Select Committee hearing as well. It's very difficult because most of these things take place behind closed doors on a one-to-one basis between firms and the PRA. And understandably, firms don't always want to reveal what's been going on in those discussions. And of course, the PRA actively discourage them from doing so. But we do have the advantage of knowing from public statements made by the Aegon Group that in respect of the volatility adjustment and its changing in different circumstances, the Dutch regulator has taken a much more liberal view than the PRA, and Aegon revealed they had to have differences in their internal models for the UK subsidiary and for the group. And I think that's a good example of where, it's a concrete example of where the PRA certainly has taken a harder line than at least one European regulator. There are lots of anecdotal comments about the PRA taking harder lines, but unfortunately that's all they are, so that it's not possible to evidence that difference. But there are strong suspicions.
It's probably worth adding, I know that James wants to comment on that, or not, given his company background, but it's probably worth saying publicly as well, you can see that not a single Dutch company uses the matching adjustment, because the Dutch regulator has taken a much tougher line on that, and I think I'm right in saying that a single Dutch company uses the transitional measures, which they've taken a much tougher line on. Both measures without which the UK insurance industry would, according to EIOPA's figures that were shown on the slide earlier, be insolvent. So it seems to me the inconsistency as much as the sort of, it's not even a level, it's not even a tilted playing field, it's just a very uneven playing field. you have any contributions in Edinburgh, James, or shall we keep the London questions coming?
Yeah, I mean, on that point, obviously, you did refer to Aegon, and that's definitely been our experience of dealing with different regulators in different countries. You do get quite different opinions on specific areas, the one that Andrew mentioned being the most public one, but there's certainly been other areas, both pros and cons. Anyone want any views on Solvency II, what people would like to change or otherwise from Edinburgh? Singularly thing. This was bigged up when we were doing the sort of introduction that Edinburgh audiences usually have far more questions than London, but clearly not this one.
You'll know that Scotland's far more pro-Remain and obviously far more pro-Solvency II. You have no comment. London's furious about it seems. But I had at least one comment over here, if that's okay.
Thank you, Paul. My name is Cameron Farugi, and I led our firm's submission to the Treasury Select Committee. And in a couple of areas, it took some different perspectives. And I'd like to share those with you and invite the comments from the speakers. The first is trying to work out what a good regulatory framework might look like. And our suggestion was to consider a regulatory framework from three key stakeholders' perspective, and then make the acid test of is Solvency II an improvement from the past, and can it itself be improved. The first is consumers of those three stakeholders. What we've seen with Solvency II is a huge upfront cost, which is clearly sunk now, so firms have spent that money. But also the suspicions from year one of implementation is that there will continue to be a significantly higher increased annual cost of Solvency II. So anything that simplifies Solvency II, brings that regulatory burden back down, will be much better for consumers because it will allow insurers to go back to selling products and reintroduce competition. And we've seen particular areas, and particularly the annuity market, where competition has suffered as a result of Solvency II and other factors. The second is the government itself. One anecdote which was predictable, and I predicted about 9 years ago, but is very unfortunate, is that with-profit funds in certain areas have actually sold government bonds to buy swaps to better match the regulatory balance sheet. That is not a sensible regulatory framework where insurers are being incentivized to do that. The only winners there are the investment banks who sell the swaps. I can see Paul grinning away and nodding. So we do need a more sensible framework for the economic basis of the balance sheet for with-profit funds, and stop incentivizing that swaps are so much more dominant than other asset classes, and particularly government bonds. And then third is capital providers. Now this can be thought of from two perspectives. The insurance industry itself acts as a capital provider to the long-term markets, and what we've seen in the early days of Solvency II is much more nervousness about the insurance industry acting as capital provider in the long-term asset classes, in particular at a time where the UK government is incentivizing infrastructure assets. This is, again, a very unfortunate and hopefully unintended consequence of Solvency II, and I would have thought it would be a strong incentive to reverse that. But also, in certain areas, the insurance industry relies on capital providers to help fund new business. And obviously, in certain areas, we've seen new business costs go up. But the complexity around Solvency II is really turning off many of the more standard capital providers who just don't understand what's going on with the insurance industry. And I think in these areas, some attempts at simplifying Solvency II, we touched on certain balance sheet aspects, I wholeheartedly agree with those, but also improving the standard formula, making that more attractive. Let's not forget the vast majority of the European industry, most companies are on standard formula. In the UK, there are many companies on internal model and others being encouraged to do so, or in a second wave. The other thing that can be done on that is actually reduce the annual burden of running an internal model. What we've seen is companies who, once the internal model is approved, have to keep doing significant extra work year after year to maintain that with the regulator. So clarity around that, I think, will help. So getting clarity around what we're trying to do with the new framework, I think, will help. And that's a proposal around stakeholders. The second one's a much shorter one, and that's around what timescales have we got to actually work on an improvement to Solvency II. With the Prime Minister's speech last week, it is now clearer that we are not targeting the day one Brexit, that there will be some transitional arrangements for financial services that will probably include the insurance industry, and that will give us a little bit more time. The question is, do we want a two-phased approach where we bring in some fairly simple adjustments early on that everyone can quickly agree with, and then take more time to consider whether a more significant change to the framework as a whole is in order? A couple of suggestions for you. Thank you.
Can I just respond a little bit to that? First of all, I'll start at the last remarks, because it's always easier. They're fresher in everyone's mind. That's very similar to the view that the Life Board took at its meeting when it was formulating its input to the Institute Faculty's response. We think that to throw everything out anyway in a hasty way would be a mistake. Any changes should be well thought through, but there are some areas where clearly early action of a simplification and removal of some of the strange effects would be a good thing. I was very taken, Cameron, with your comment about the capital providers not understanding Solvency II. Well, I would go a step further and say I'm not sure anybody really understands how Solvency II works in all the different circumstances. I would venture to suggest that most experienced actuaries in previous regimes had a pretty good idea how the balance sheet was going to respond to any given circumstance. But it's somewhat more difficult today. It's so much more complicated. The behaviour, whether it's of an internal model or even the standard formula, can be sometimes counterintuitive. And I think it's a weakness of the system that actually there is less understanding of the system than there was before. And I strongly agree with the comments you were making that simplification is importantly needed. I was interested also in your suggestion that the costs are higher this year than the past. I'm not sure whether that is entirely the fault of Solvency II or actually just the general regulatory creep, the extra information the regulators always seem to need. Well, I was going to say year on year, but it seems more like month on month. And I think that is probably would have raised the costs anyway. But it's a valid comment. Why should those costs keep rising? Because ultimately, the person who pays is the proverbial man on the Clapham omnibus, whether it's one or two. And I think it's something that really we need to go back and think about again. Is this really in the interests of the public?
I mean, I don't know if it's worth... look, I'm very sympathetic to a lot of what you said, and hopefully that came across in what we said up there. And I think your comment about selling gilts and buying swaps, I think it's slightly interesting that, the traditional counterparty on swaps has been banks. And, if everyone moved to swaps, then you're linking the insurance industry to the banking industry, because if your counterpart falls over, then that swap is there to reduce interest rate risk, and suddenly you've got a whole load of interest rate risk back on your balance sheet because your counterpart has gone bust. Central clearing, of course, goes a long way to addressing that, but I don't know how far it goes in terms of something that is truly systemic. But I think it's a valid point. To me personally, there's something wrong about discounting generally within Solvency II. Otherwise, I agree with you. I think models are too complex. I think Solvency II works well for, the whole thing about a one-year VAR. It works well for non-life companies because that's the term of their contracts, annual renewable contracts, typically. There's something that doesn't work for long-term business.
So then I was smiling a bit on the gilts versus swaps, partly the reason you alluded to, but partly because of the history. If you actually look back into the history, the risk-free rate in Solvency II in its early development was government bonds in the Eurozone. The UK were the ones who lobbied for it to be the swap rate. It's actually something we almost push the rest of the continent into. So I think generally in Solvency II, you sometimes need to separate the things that sort of is the almost UK imposed on itself. Frankly, some of the complexities around transitionals that we talked about earlier would be another example, and the things that sort of are more a European-wide regime being imposed on us, which perhaps the risk margin would be a good example. And I think in a way the debate, those two things can get quite muddled up in the debate. Edinburgh, any response there yet? Any life in Edinburgh? Or non-life? Or pensions?
Yes. We have someone who's willing to make some comments.
My name's John Gill. Just to have a question, I think primarily for Dick here, about the working party's desire for the UK to take more control and make changes to Solvency II will clearly, inevitably, over time, drive bigger divergence between the UK and Europe. And just in terms of managing future equivalence in that environment, has the Working Party considered that and how they would seek to manage that?
With you, we haven't considered that. I mean, the role of our Working Party is truly to perform a retrospective. What we have done for this evening's debate and in response to Treasury Select Committee consultation is that we produced a one-off set of opinions, and whether we take it further and how we incorporate that into our paper has yet to be decided, to be honest. I'm sorry, that's a bit of a non-answer. I mean, Dylan, is it fair to ask you if you've got any thoughts on that particularly?
Yeah, I think I'd have to echo what you said there. We didn't go into making sort of definitive proposals for how the UK can fix Solvency II and how we could actually make that happen in practice.
I think generally we need to consider this in a wide context, because as time moves on, the EU will make changes to all sorts of things, Solvency II amongst them. And we are going to have to decide whether we like them or don't like them, whether we want to go along with them or not go along with them, because we won't be at the table when those decisions are taken. But equally, we may want to make changes ourselves. And always, I think the test will have to be, do we think we are going in the right direction for the UK or not, in the broadest sense? That said, we mustn't lose sight of the fact that there is something called the IAIS, the International Association of Insurance Supervisors, which operates really under the auspices of the G20 to some extent. And that organisation is trying to produce global capital standards and global systems for the solvency of insurance companies, the intention of which is to produce some sort of level playing field and security for the system at large. That will tend to pull things back together again to a degree. But the EU is a powerful voice there, but it's not the sole voice. I mean, there are other countries which have different systems, not necessarily the same as Solvency II. And you can think of Canada, you can think of Australia, as well as the system in the US, which is clearly a country that is not quick to move to other people's systems, to put it mildly, and probably much slower now than it was a few months ago. So I think that there is an awful lot of complexity in this, and I think it'd be very difficult for a working party to give an answer to that question.
It sort of feels it here a little bit, where it's an interesting challenge for us, I think, Life Board, Life Research Committee, is whether we ought to be doing that or not. I think in our response to the Treasury consultation, we probably downplayed that aspect a little on the grounds that was a sort of the world of the insurance lawyer, perhaps, rather than the insurance actuary, question mark. In other words, is that really our, exactly what counts as equivalence or passporting or whatever is not maybe our biggest value add, but it's obviously quite important. I mean, one thing I'm taking away is whether we ought to be thinking about that more, actually.
I mean, is it not the case. I mean, I think the divergence will happen in terms of long-term business. I don't think necessarily for short-term business, non-life, that there will be much divergence. But, you know, if we're taking the cue that Brexit is Brexit, I see no reason why our version of Solvency II would diverge from the EU's. And we have got greater scope to make changes. I suspect that the EIOPA review, because of the constraint of perhaps negotiating things at a directive level, has got less opportunity to be flexible. I mean, we could, for example, move to a gilt discount rate. And, you know, that is true risk-free. The UK government can print more money. So, and would that jeopardise equivalence? I mean, I imagine that's an ongoing political discussion.
Can I put a provocative statement in to try and get some of our non-life colleagues to say something? What about periodic payment orders? Should the UK be changing Solvency II for a post-Brexit to accommodate a better and more realistic treatment of periodic payment order liabilities? Just a thought.
Well, Andrew, sorry, picking up that, you read the directive, and it's almost intended that it should pick it up because it does say non-life liabilities as well. But it's just the fact that the indexation doesn't meet the more restrictive criteria around matching adjustment.
You can't meet the matching adjustment requirements, that's the problem.
Yeah.
We have many non-life actuaries in the room, but if anyone wants
we
to...
do.
They're just being silent. I suppose the other thing that's worth saying on equivalence is, I mean, you look at the Swiss regime is deemed equivalent. It's pretty different to Solvency II. It's similar in its broad intent, and actually they were the ones, if anyone wants to know where the 6% for the risk margin that we all hate comes from, it comes from the Swiss. They have the risk margin, but they have various other things that are very different. The Bermudans, I think I'm right in saying, have a version of the matching adjustment that we would probably be much happier with, which is less binary. So even, existing Solvency II equivalent regimes have flexibility. So I think there is quite a big opportunity, even within maintaining equivalence. Do we have a contribution from the floor from London? One in the back there.
Hi, I'm Amrita Patni, and I'm currently chairing the Solvency II Practical Review Working Party, which is carrying out a review from the non-life perspective. And yeah, so PPOs is definitely one of the things that we'll be looking at because of the limited guidance around the treatment of PPOs. But just another question is that obviously a common theme is that we'll be incorporating Solvency II with a few changes. But when, around the timescales, when will we get the final decision from the Treasury Select Committee, and will they recommend, a list of what areas need to be improved, or is this going to come from us? And also, how will the improvements be managed? Will it be through working parties, or that's something that we thought about later?
Select committees, the House of Commons, set their own agenda and their own time frames. They can take as long or as short a time as they see fit. A lot depends on what comes out in the hearings they have. The hearing that I gave evidence to was the first, and there are several others planned. And depending on what comes out from them, it'll make a difference to how long they take over it. What they do is they produce a report that's presented to the House of Commons formally, and is effectively a report that government reads and listens to and responds to. And that will be the test of what goes on in the future. I don't think at this stage anyone can predict any time frame or any clarity as to how that would happen. The IFoA can respond now to further questions from the Treasury Select Committee or its staff, and there will be dialogue with them behind the scenes at this phase. As far as formulating things going forward, I think it is going to be something that is going to be an ongoing theme for the IFoA over the next 2 to 3 years. Whilst there will be a transitional period, we believe, that has got to be agreed, but you clearly need to be ready for what happens at the end of that, before the end of that. So you can't afford to sit back and wait on the basis that there is a transitional period. You've got to start thinking about what you want to do and how you want to do it as soon as possible. And I think it's inevitable that we will be forming new working parties, whether under the auspices of the Life Board and the Life Research Committee, or under the General Insurance Board, or joint working parties, remains to be seen. But it is something that, for instance, the Life Board is going to be talking about what comes next at its meeting later this week. And I hope it'll be informed a lot by the sort of comments we do get from you this evening. Do give us thoughts about where we should be looking and what we should be doing, because the time will go faster than you think.
Got a question here in London, unless you have one in Edinburgh.
We do. I'll hand over to David. Do you want to? Thank you.
Thanks very much, James. I would hate Edinburgh to lose its reputation for being vocal on actuarial things. I suppose these are unplanned comments, but prompted by what I've been hearing, and there's sort of two quotes going around in my head, and one of them is that we wouldn't have started from here, and it seemed a good idea at the time. And I think Solvency II did seem like a very good idea at the time. And it was welcome. And I suppose the other quote that was going on in my head was, I think, Napoleon, who said that the one thing man learns from history is that man doesn't learn from history. And I'm slightly feeling that in fact Solvency II hasn't really learned from its beginnings, because very early on in the beginnings came the Sharma report, and those of you who know me know that's a favourite topic of mine. But that was the report that regulators, led by Paul Sharma of the FSA in those days, and Gabriel Bernardino was a member of that working party. And that was a working party that looked at why insurance companies fail or have near misses. And it came out with a startling recognition that it's nothing to do with capital, it's to do with what management does. And it was, so they tell the story in that report of various sort of imaginary near misses, but they're based upon actual events and companies that went wrong. And, so the whole idea of Solvency II, that was then prompting the regulatory toolkit that the regulators would then need to have. And so Pillar 2, figured very strongly in those discussions. And yet that's the bit about Solvency II that we like and wish it would dominate more, but we've had all the discussions over Pillar 1 and trying to get capital right, when in fact most of us would say that there's no way you can get it right because all the models are wrong. All models are wrong, but some models are useful. So we've ended up spending a lot of time developing really sophisticated models, which are more sophisticated than the data that we have to populate them with. And so then when you stand back, you think, well, we haven't really learned from history about the importance of Pillar 2 because we've kind of downplayed that by trying to get Pillar 1 right. Where we have, I think, learned a bit from history is, and I may be saying slightly tongue-in-cheek, but in the early 2000s, if you wanted to sort of paint a sort of a cartoon of the industry, the feeling was, banks understood risk and they ran themselves well, and insurance companies didn't. And then during the 2000s, it turned out that wasn't the case. In fact, insurance companies mainly got through the credit crisis, except those ones that didn't hedge variable annuities particularly well. But the banks didn't come through the credit crisis too well. And interestingly, it was the consequences of that showed the weakness of Solvency II, because Paul's right to highlight the history that, in fact, the swaps rate was put in because it was the only way to get a higher discount rate from market-consistent people than using a gilt rate. That was how it got in market-consistent EV and things. And then it turned out, when the swaps rate went below the gilt rate, this was a bit of a problem. I think very few people would have expected interest rates to fall to quite where they were. So, and of course, any regime that's based on discounting is going to be under pressure when you're discounting at 1%. for many, many years. So it's strange that, we have learnt from history in some ways, and actually what it's then highlighted is that, in fact, Solvency II was not as robust as people thought it would be, and that market consistency was not the answer to all questions the way it might have been interpreted in the mid-2000s. And in fact, the risk margin, that came from industry as a way of avoiding the question of what percentage solvency should technical provisions give. And the answer was, well, let's not think about a probability, let's think about a cost of capital approach. The philosophy of it was beautiful. The only trouble is that we've now got a situation where when you move from prudent reserve to best estimate and a risk margin, you end up with a higher number than if you'd been in a prudent reserve to start with, or that's what it feels like a bit for some products. So unfortunately, it's not worked out the way we should. It seemed a good idea at the time, but unfortunately the world became more complicated, and some of the pragmatic approaches that were being pushed proved not to be pragmatic enough. And I suppose I do wonder whether the solution to all of this is not to throw everything out with the bathwater, but actually having, one of the aims of Solvency II was to actually recognise what margins were in balance sheets. And there are advantages in having that sort of level of transparency. But I wonder where one of the solutions would be whether we could actually have the same level of transparency over the implementation of the Solvency II framework. And I do worry slightly when companies that had an ICA regime and an ICA model that was acceptable at the time, supplementing the Solvency I regime. And then it turns out that their measurement of capital and their assessment of risk drivers is not adequate because the regulator has a model that they're using to test the model against. But that model that the regulator is using has not had the public scrutiny that perhaps something of such a contentious nature might benefit from having. And I wonder whether if there was more debate over, what are the pragmatic judgments that we're going to hold, recognising that we cannot assess all these risks perfectly, but we can do a good job as well-trained risk professionals. But we need to recognise that it's not going to be a perfect answer, but we need to have some way of communicating the uncertainty to the politicians and the regulators who set our standards, but they need to have the same level of, I think, transparency coming back, particularly in terms of how much capital is required for certain risks. Otherwise, we end up having a distorted market that nobody feels they can trust. And I think, after all, the whole point of this is so that customers can trust that insurance companies are going to be there. And I think the level of distrust that we have just now over the capital standards is not necessarily helping that, nor the value that customers get for it. Not really a question, more some reflections from history. I know Andrew's at least as old as me, if not older, as is Dick. So hopefully I'll be interested to know what their responses are to that. Thanks.
Well, sure. I mean, thanks, David. That was very interesting. I've got a couple of comments there. One is, I completely agree with the complexity of the models. And, correct me if I'm wrong, my understanding is that no Big Four company would want to audit an internal model. And in actual fact, I don't know how comfortable the regulator feels, because quite honestly, as a consumer, I look to him to make sure that these models are actually correct. It would be, in my mind, it would be nice to think that we could run the system off of more simple models. The rating agencies have got fairly simple models. The trouble is that the life insurance industry does have a habit of arbitraging these models. It seems incapable of standing back and taking a more measured view as to how to optimise, say, its asset allocation or its asset liability management. We all hark back, you mentioned prudent reserving, and it's interesting. There are two things that have gone on in the last 10 years. One is continually falling interest rates, and the second is the introduction of Solvency II. And a lot of the problems are not to do specifically with Solvency II, but to do with the interest rate environment that we're working in. And the question I have is, how prudent would these prudent reserves be in the current interest rate scenario? And what would the regulator's response be to them? Because I'm not sure that I see any prudent margins left in them, but at least on the rate side.
I think you've managed to single-handedly restore the reputation of Edinburgh, David, so congratulations for that. Back to London. We had a question at the back there, so we'll pick that one up first. And
Alex Markson. I was slightly cross with you for accepting David to speak before me, because now I have to follow his act. But thank you for the presentations. I think the important thing is actually just to position ourselves sort of with taking a common sense view, because I think the biggest challenge, the biggest criticism of Solvency II has been it started at a good place and then it almost got too much into the theoretical discussions. And I think the more we have to keep challenging ourselves to pull ourselves back to that. I think there's easy to address the silly things or things that look wrong, whether that's, and I'm speaking here as a general insurance actuary, so life insurance actuaries, forgive me if I speak out of place, but some of the things where you look at the long-term interest rates that are used and they don't bear any relationship to the gilt or the long-term interest rates, and you just think, how have we managed to get ourselves in a system where we have some crazy-looking features there? I think the question about gilts versus swaps is an interesting one, and it's for us as a profession to push back on the tendency for people. Someone talked about arbitraging the models, but to push back on companies trying to close couple and actually removing the slack from the system, because what you know that while the theory may be fine, in practice there's always stuff out there that doesn't that comes back and haunts you. And I think it's very important that when we're acting that we do constantly challenge ourselves, given that we all work for the industry and for companies or consultancies, that we're not finding ourselves in a position where we're lobbying for things that against costs that the industry has to bear or feels that it has to bear. I think one of the things that concern me in that vein is almost recognise the way in which we think about the externalities of the changes that that Solvency II brings. So whether that's in insurer failure and companies being required to hold more capital or have better risk management, yes, there's a cost, but we also need to talk about the benefits and recognise the benefits, even though they are difficult to actually get your hands on, because the cost of insurer failure is very severe and affects the few in time and with policies, rather than the many who avoid the costs. And similarly with disclosure, it's very easy for everyone to stand up and say it's nonsense, the costs of all the disclosure, but we really need to think hard about the externalities in that respect, and about if greater disclosure reduces the scope for management to extract assets from the companies, then maybe we need to make sure we are taking a balanced view and think about the broader public interest position there.
Thanks. Just pass that to you, Andrew, because I know that came up quite a bit at the Treasury Select Committee, I guess, whether the balance between consumer choice and value and security, I suppose I think you were taking the view that it perhaps tilted too far one way.
Yeah, I do personally take the view that it has tilted too far towards security and too far away from value for money for the consumer. And I think we have a number of issues to face, and I think the common sense approach idea is certainly one that I would support. We need to go back to the principle. The principle is that we want the insurers to pay out the claims in full at the time they're due. And we want to be testing that they have the resources to be able to pay out the claims when they fall due, whether that is in a week's time or in 40 years' time. And the balance sheet and the review of the balance sheet and the capital that is held on that balance sheet is all about whether or not they can fulfill that ultimate objective. And we've got overhung up on balance sheet tests and more extreme balance sheet tests against more and more extreme balance sheet events and lost sight of what we're trying to achieve. And you can end up with balance sheets that appear to work and you'll not pay out the claims, and balance sheets that appear not to work and you can pay out the claims. And we need to get back to that focus. And I think the trouble we have is that we have all these debates on swaps versus gilts. The problem with the swaps versus gilts issue, which is a consequence of the way Solvency II is structured, is that it artificially alters people's investment policy. And anything that does that artificially is not right. What we ought to be focusing on is something that is closer to what the IFRS is pushing you towards, the new IFRS proposal, which is to look at whether the assets are capable of, or there are assets capable of producing the liabilities at the time that adjusted for the risk of those assets. And that, of course, is something that's very familiar to us with actuaries, because that's the approach we've been using for years. Solvency II takes you away from that approach, and Omnibus 2 was called in to get you a bit back towards it, because they realised that going away from it didn't work. And as I said to the Treasury Select Committee, you had something that didn't work, they produced a convoluted method to try and get you back to it, and that doesn't really work either. So there are some fundamental changes that will be needed. And maybe we should be looking a little bit closer at what I believe is going to be IFRS 17 to get us some of the solutions there.
Andrew,
question
sorry,
here, but
can I just ask Andrew a question in that respect? I mean, you're right, there is all this swaps versus gilts thing, but when you look at the UK and the business that the UK is writing today, it's principally annuity business. And the only area where the gilts versus swaps aspect comes is in respect of the risk margin. Otherwise, we're discounting on a discount rate based on the assets. It's essentially along the lines of Solvency I. Is that a fair comment?
Well, provided you jump through a whole load of hoops to get the right assets that qualify for the matching adjustment, that is true.
Yeah.
But again, that's another aspect of the problem. But there are blocks of business where that isn't true. And in any case, are we actually saying we want the only products that the life assurance industry produces to be annuities? And are we actually able to write sensible, longer-term policies that actually customers, the consumers, really might need and want under this regime? I would suggest probably not.
I'll come to you, but I'll just check if Edinburgh have got a... We've got a question in London, but...
Another question in Edinburgh as well. So.
It's Ian Rogers. I just wanted to pick up on a couple of points that have come up through the discussion. Paul, you mentioned a challenge really about whether actuaries have a role in the legal aspects of equivalence and what equivalence might mean, and picking up on a point from Dick's presentation, and which has just come up in the most recent discussion about the kind of the burdensome nature of the matching adjustment eligibility requirements. I'd contend that actuaries do have a big role to play here in proposing a new regulatory regime and an interpretation of the regulatory regime which works. By way of example, I'd point to equity release mortgages. Some would say that the activity that the industry has been pushed into to securitize books of equity release mortgages which contain at their heart well understood demographic risks which insurers are well placed to model, and to construct matching adjustment consistent default risk out of that demographic risk through securitization is artificial and unduly burdensome. However, taking a look at it from perhaps the PRA's perspective, what they're doing is using legal rigor and the precision that comes from the securitization structure to ensure that the principles of the regulation are being met. The alternative would be to leave it to use a sort of fixed enough kind of approach, where you defined fixed as not being actually legally fixed, but fixed subject to some sort of probabilistic test. And you can see why the PRA would be skeptical of that, because they would see the temptation of insurers to backsolve for fixed enough to be however fixed they really were. I think actuaries and in the Institute, in sort of providing a voice for actuaries as a whole, are well placed to kind of contribute to this and to identify areas where, in the regulations as they're implemented at the moment, legal rigour is being used to ensure consistency, where perhaps there might be an opportunity for a less burdensome approach, which relied more on actuarial principles of risk modelling and understanding probability, but with the same degree of transparency and consistency that is ensured via a hard legal interpretation of the rules. So I'd welcome I welcome the working party's work and would suggest that that is an area that would be worthy of further consideration. Thank you.
Thank you. I mean, I'd certainly agree that one of the areas we would be looking for, if we do have the options through the Brexit process, would be to try and loosen some of the bureaucratic natures of some of the application processes. I guess, remember the discussions when we were responding to the Treasury Select Committee at the Life Board and the challenges around equivalence, and that almost coming to, do you wish equivalence or not, and what do you wish to do? And fundamental challenge that we have, that we start off being fully equivalent, and any change we make will immediately make us less equivalent. Whereas the Swiss and the Bermudans, we're doing a high-level comparison. So it's going to be a big challenge, and I think that political choice will underpin a lot of what we push for or desire to do. But interested in Andrew's views and others as well.
Yes, James, you've identified a clear problem. As of Brexit Day, we will be equivalent because we will be on Solvency II, and then the clock ticks past. Now, we then are no longer under Solvency II technically because we'd have Brexited, but we would have the same regime. Could we guarantee equivalence? Well, of course, there's a slightly political element because the European institutions have to grant equivalence. They might or might not do so, or they might drag their heels and take a long time to do so. That'll all be part, no doubt, of the Brexit negotiations. But as soon as you then start changing it, are they going to use that as a justification for saying, well, you're no longer equivalent, you're Solvency II, but tweaked, so therefore you don't count anymore? Whereas you might have adopted, shall we just say for argument's sake, we might have adopted word for word the Bermudan regime. And this is just hypothetical. I'm not suggesting we should do it, but let's just assume that that is what we did. Would they then say, well, you're not equivalent, but Bermuda is? We just don't know. And unfortunately, and I think the reason why the view is that actually this is one for lawyers is because ultimately it'll be the European legal system that decides what equivalence means. It's not going to be what actuaries think, it's going to be what lawyers think, and lawyers presumably in the European Court of Justice. And we all know that they can be rather unpredictable.
I'll come to the comment we had here. Thank you for waiting so long.
Thank you very much. It's Tony Silverman here. I just had quite a practical question, actually. I think there's nothing fundamental. It's a coincidence, purely, that the non-life sector generally this works for, as has already been commented on, and the non-life sector, or these significant players in it, would like to have passporting. I think those two they wouldn't necessarily have gone together. Equally, the life sector, it doesn't work for, and they're not particularly interested in passporting. And again, it's equally a coincidence that those happen to have gone together, but that's where we are. So I'm just wondering, in practical terms, and coming back to the equivalence, what happens, because you might want to make some changes. They'll mostly be, if you like, for the life sector. And as you say, you then put equivalence at risk. So how is this going to work? And is perhaps an alternative to simply say, well, there's no point in saying, well, just for this purpose to say we'll adopt the Bermudan one. What if you actually take that argument a little bit further and say, we'll have a regulatory regime that simply does whatever Solvency II is, with no quibbles and no influence and no questions asked. But we'll have another one as well, which you may choose, which the EU may choose to completely ignore and has perhaps no hope of equivalence, and just run the two.
Well, I certainly, there were some comments from the Treasury Committee that made me think that they were already thinking along such lines of a...
I've suggested.
Yes, and certainly I think it was Jacob Rees-Mogg that was alluding to the possibility of such divergence, and it's an interesting one. But equally, there is a precedent going back to the Solvency I regime, where for Swiss companies, I think I'm right in saying non-life companies could passport, but life companies could not from Switzerland. So again, there is another possible model that you might be able to do. You'd probably find that those handful of remaining composite companies wouldn't be able to passport, but I think that would be a cost, a price that could be paid. There aren't very many of them left.
Yes, absolutely. I think the Swiss position is that they don't passport, they just have a bespoke agreement which enables them to do a defined list of things.
Yeah, he has the same effect.
Yeah, absolutely. So imaginative approaches are possible.
There is actually no word passport used actually in formally. It's just a colloquialism for what goes on.
Just give a very simple example. Our favourite topic is the risk margin. The Dutch have a line of business funeral insurance that, for reasons that escapes me, doesn't get regulated under Solvency II. So they use the Solvency II regime, but they've cut the risk margin to 4%. Which we might like. Maybe we have 4% risk margin for annuities and less of it into another country and it's 6%. It literally happens in other countries. So, James, I'll hand back to you, and I guess we're getting probably near to the end of discussion time, but in fact, I'll have a quick show of hands. Anyone in London has a burning question they want to ask? That sets the bar high, doesn't it?
Or comment.
Or otherwise, maybe I'll pass back to you, James.
So has anyone in Edinburgh got any final comments that they'd want to throw into the mix? Otherwise, we'll move on to wrap up the evening. I think obviously interested in hearing Andrew's experience in front of the Treasury Select Committee, and certainly encourage people either to watch the video or read the transcript if you're shorter of time. It was clear they certainly gave it the proper focus and grilling and sort of applying that, and so well done to Andrew for representing the IFoA in that experience, which I'm sure he enjoyed in retrospective, not immediately beforehand. I think, and thanks also to Dick and Andy for giving an overview of some of the views from the Working Party on the retrospective view of Solvency II, which became much more topical with Brexit and actually a much greater likelihood of potential changes coming along, so a very timely Working Party. And obviously there will be ongoing challenges in the TMTP Working Party, and looking forward to seeing the paper come out, though from a theoretical point of view rather than practical, because I recommend selling annuities to get rid of having to calculate transitional arrangements. The Q&As, I think, highlighted that finding a common view on what we want will be as easy as finding a common view on what the country wants as a whole from Brexit. And I think there's definitely a role where we can help to influence and shape the opinions, and I think encourage people to continue to input through working parties or events like this. It's clear that we're going to need to balance things like the views on do we want passporting and equivalence, and GI side and non-life side will have different views to the life side, I think, and then identifying the areas where the level of security that we want versus the current levels will be a key part. But I think we could all join in hoping that, certainly on the Pillar 3 side, we might be able to shave off a few of the challenges that currently got that. The downside, of course, is that we've got 2 years to go, and by then we will have developed all the systems and requirements anyway, but cutting out some of the costs on the ongoing basis will be helpful. But I think the final thing is just to give a vote of thanks to all the speakers tonight and also to all of those who participated in the discussion. And thank you for your patience.